looked at the market and just wondered if things are maybe too calm? You know, that feeling where everything seems okay on the surface, but you suspect there's something else bubbling underneath.
Oh, definitely. That sense that the quiet is maybe a bit deceptive.
Exactly. Well, today we're diving into a concept that really captures that: controlled fragility, especially in options trading. And we've got some fascinating source material for this: market analyses, actual trade logs, even internal system reports, all from one specific day, September 4th, 2025.
Yeah, it's like getting a peek behind the curtain, isn't
It
it?
really is.
Our goal here is to, pull out the key insights from all this, the aha moments. We want to show you not just what trades these expert systems made, but really dig into the why and the how they managed risk in that complex environment.
So you can walk away understanding how to approach uncertainty with a strategy that, well, protects your downside but still lets you capture potential gains.
Precisely. A strategic mindset for uncertainty.
Okay, let's unpack this term then. Controlled fragility. It sounds a bit like an oxymoron, right? Calm but fragile.
It absolutely does, and that's the whole point. It describes a market state where things look calm. Your main volatility gauge, the VIX, might be low, but underneath, there are significant hidden risks.
So not really bullish, not really bearish.
Exactly. It's this kind of in-between state that needs a really adaptive approach.
Hmm.
Some of the sources called it full send with adaptive guardrails, which I think paints a good picture.
Full send with guardrails. I like that. So the VIX is key here. What was it doing on September 4th?
Right. So on that day, the VIX was hovering just under 16.5,
Yeah.
somewhere like 16.3, 16.4.
Okay, and 16.5 is kind of a line in the sand.
It often is, yeah.
Yeah.
Below that can signal complacency. But the analysis was clear. There was an active fragility bias, meaning despite the low number, the market was seen as inherently unstable. And there was this mean reversion risk.
Mean reversion risk, meaning if it popped higher, it could really move.
Yes, exactly. If the VIX jumped above, say, 17.0, the thinking was it could signal a sharp, sudden shift. So calm, but potentially explosive.
And it wasn't just the VIX sending these weird mixed messages.
No, not at all. The pre-market analysis actually showed conflicting signals, too. You had some bullishness early on, around 18:00 a.m. Eastern, but then later, closer to the open, more defensive positioning started showing up. That definitely flagged heightened uncertainty.
What about other sentiment gauges?
Mixed bag there, too. The Crypto Fear and Greed Index, neutral, right around 51, 52. The AAII Sentiment Survey, the one for individual investors from the week before, that actually leaned bearish.
Interesting.
And even within the SPY options market itself, there was a notable put skew.
Meaning more demand for downside protection
Well,
puts.
The open interest put-call ratio was around 2.5, so lots of people were holding insurance, essentially reinforcing that defensive undertone despite the calm VIX.
Wow. Okay, so you've got a low VIX suggesting calm, but fragility underneath. Early bullishness turning defensive, mixed sentiment, a put skew. With all these conflicting signals, how on earth do you even begin to formulate a coherent strategy?
Yeah, it's a puzzle. And that's where this specific strategy, the controlled fragility barbell, came into play.
Barbell, like weights on either end.
Exactly. Think of it like that. Heavy weights on both ends. One end is your robust downside protection, that's the left tail, designed to hedge against a big drop. The other end, that's focused on high upside opportunities, the right tail, try and capture those amplified gains if things move your way.
Okay, I get the concept. Let's break down the assets then. First, the left tail, the protection side. SPY was the anchor. How did that work?
Right. SPY, the big S&P 500 ETF, was primarily the fragility hedge. Its job was downside protection. The specific strategy was buying SPY put options. Remember, puts profit if the price falls. They allocated about 3% of capital to this.
And why SPY put specifically? What was the thinking?
Well, the analysis suggested SPY looked overbought. Maybe it had run up too fast and was due for a pullback. Plus, there were signs of institutional distribution bias.
Meaning the big money might be selling?
Potentially, yes.
Huh.
So hedging seemed prudent, but what's really cool is the execution on the day. The system bought those puts, it captured the weakness when SPY dipped below key resistance, and then it got out just before that strong recovery move later in the day when SPY bounced back up.
Wow, so it timed it almost perfectly.
Extremely precise timing, yeah. Great risk management, locked in the profit from the dip before the rebound erased it.
Okay, so that covers the defensive side, the SPY puts. Now for the other end of the barbell, the right tail, seeking those bigger gains, this is where Bitcoin or the BTC ETF Mini comes in as the gatekeeper. What's that about?
Yeah, the BTC ETF Mini, it was viewed as A momentum convexity play.
Convexity, meaning it can really amplify moves.
That's right. Highly sensitive to momentum, potential for outsized returns, and it was also seen as a leading indicator for general risk appetite in the market.
So if Bitcoin's doing well, maybe riskier assets generally will follow.
That's often the thinking. The initial plan, based on the pre-market analysis, was actually to buy BTC ETF call options betting on a price increase, allocated about 1.5% capital.
And what made it look bullish initially?
Several things. Its implied volatility was seen as cheap, about 42%, meaning options weren't overly expensive. It had seen strong inflows the day before, over $8 million.
Okay.
And there were some positive catalysts swirling around, like news about a potential Trump stake.
Okay.
It actually had the highest risk-reward score, an 80, from one of the key analytical models, the CSAC model.
So on paper, Bitcoin looked like a pretty strong candidate for the upside play, but I get the feeling there's a twist here. Did they actually make that trade?
You picked up on that. No, they didn't. And this is crucial.
Why not? What happened?
Despite all those bullish signals, when the market opened and trading began on the 4th, Bitcoin itself showed a bearish breakdown. The spot price fell below a key support level, around $110,321, and other indicators like MACD were flashing strong bearish momentum.
I see. So the real-time action contradicted the plan.
Exactly. So the system's logic was no confirmed 1 in 11K breakout discipline maintained. It didn't take the call trade because the price action simply didn't confirm the bullish thesis. That's critical risk management. Sticking to the plan requires confirmation.
Discipline over desire. Makes sense. Okay, so BTC was a planned right tail play that got shelved due to risk management. What else was on that side? TSLA, the amplifier?
Yes, TSLA. Called the amplifier because, well, it tends to amplify market moves due to its high beta and very active options market.
High beta meaning it moves more than the general market.
Correct. More volatile, both up and down.
Yeah.
It was targeted here as a high upside convexity play, specifically looking for an oversold bounce.
Oversold? Had it dropped a lot recently?
Yeah, its RSI, a momentum indicator, was down near 23. That's considered extreme oversold.
Yeah.
So the thinking was it was due for a rebound. The plan was to buy TSLA call options, SEP 612333 calls, with about a 2% capital allocation.
Betting on that bounce.
Right. And there was also potential for what's called gamma activation. If it got above the $340 resistance level, that's where options dynamics can accelerate a move.
So did the system execute on TSLA?
It did, but with a slightly different tactic. It actually used a TSLA straddling strategy.
Straddle, buying both calls and puts.
Exactly, buying both. This strategy profits from a big move in either direction, basically betting on volatility expansion.
So if TSLA made a big move up or down, the position could profit.
Precisely. And it worked out. The logs show profitable call and put positions on TSLA for the day. It actually caught TSLA's inverse pattern relative to SPY's recovery later in the day, which validated the system's reading of cross-asset divergence.
That's really clever, profiting from the volatility itself. Okay, so we have SPY puts for defense, BTC calls planned but held back, and a TSLA straddle capturing volatility. That's a lot of analysis and specific plays. You mentioned different systems like CSC. How do all these different analytical parts actually work together? Does it just create confusion?
That's a great question. Sounds like it could be noisy, right? But it's more about synthesis. Think of it as a unified brain.
Yeah.
You have several key systems, each with a slightly different focus. There's quasi-portfolio strategy, that's kind of the high-level strategist, looking at models, sentiment, catalysts, risk-reward scores.
Okay.
Then DOTA's V2.0, which is really focused on convexity, gamma dynamics, short-term options like the TSLA play.
Got it.
EdgeNexus is more execution-driven, watching market fragility in real time, looking for assets moving together or diverging. OmniProfit Nexus does things like the closing bell analysis and helps define that overall control fragility posture, looking for momentum differences. And finally, AlphaCore V3.15 is the integrator. It's the real-time unified execution engine that takes inputs from all the others and actually places the trades.
That sounds incredibly complex. Getting them all to sort of sing from the same hymn sheet must be a challenge.
It is complex, definitely. But the key finding was that they generally converged on the main theme, this controlled fragility idea, and the barbell strategy. They offer different perspectives on the same underlying data, which actually strengthens the conviction.
So reinforcing signals rather than conflicting ones, mostly.
Mostly, yes.
Yep.
It provides a more robust picture. There's actually a funny story, an internal document nicknamed the apology.pdf.
Oh.
Yeah, Apparently, one analyst initially criticized the whole multi-system approach as way too complicated. But after seeing the results, the consistent profits and effective risk management, he basically wrote this mea culpa, acknowledging the complexity wasn't a bug, it was a feature. It worked.
Huh. The numbers don't lie, huh? Shows the value of that layered approach. Okay, so we have the strategy, the systems working together, but even then, markets can go wild. What about the safety nets, the guardrails in this controlled but fragile world?
Absolutely critical. Risk management is woven throughout. A core piece is the VIX-triggered dynamic hedging. There's a very specific VIX trigger matrix.
Okay, like rules based on the VIX level.
Exactly. If VIX hits 16.5, initiate small hedges using UVXY calls. That's an ETF that basically bets on volatility going up.
Right.
If VIX hits 17.0, activate full hedging, maybe a 5% allocation. VIX at 18.0, reduce overall exposure by 25%. VIX at 20.0, cut exposure by 50%. And if it spikes to 25.0, emergency protocols, close all risk.
Wow, very structured. So what happened on September 4th with those triggers?
Well, the VIX actually closed the day down around 15.30, deep suppression. So those UVXY hedges were technically armed but inactive. The system was ready, but the conditions never got severe enough to require that level of hedging.
Which shows the environment stayed within the controlled part of controlled fragility.
Precisely. And beyond the VIX triggers, there are other layers. Strict position sizing, never more than 3% of capital in one strategy. Total options exposure capped at 20%. Hard stop losses are baked into below key technical levels. Like if TSLA had dropped below $323, the system was programmed to exit automatically.
Makes sense. Prevent a small loss from becoming a big one.
And then there's the big one, the kill switch protocol.
Kill switch. That sounds serious. What does that do?
It is serious. It's designed for extreme market stress, those unforeseen events. Its purpose is to instantly flatten all long exposures, sell all your calls, all your stock positions. But crucially, it maintains the hedges, the puts, the VX, UVXY positions.
So go completely defensive in a crisis. What would trigger that?
It requires a combination of severe signals. For example, SPY dropping below 640 while the VIX is above 18. Or maybe BTC crashing below a critical level like 47.5. Or if all assets suddenly start moving perfectly together in a panic, like correlation spiking above 0.9.
Did that get triggered on September 4th?
No, thankfully, it was never triggered. SPY held above 640, VIX stayed below 18. Correlations didn't spike that high. It just further confirms that while fragile, the conditions remain managed. And you also have really granular timing rules for execution throughout the day, showing discipline down to the minute.
It's just the sheer precision is incredible. It's not just about making money, it's about obsessively protecting the capital. So let's get to the bottom line. All this complexity, the strategy, these systems, the risk controls, did it actually work? What were the results on September 4th, 2025?
Well, the proof is in the pudding, as they say. The overall performance grade for the integrated system on that day was A+.
Exceptional.
A+.
A plus.
That sounds good. What does that translate to in terms of returns?
It was translated to a plus 12.3% daily return on the baseline $1,000 portfolio used in the report.
Wow, 12.3% in a single day. That's significant.
It absolutely is. Now, you wouldn't expect that every day, of course, but it shows the potential when the strategy navigates these conditions correctly. And maybe even more impressively, the Omni Profit Nexus system reported a 100% win rate for the day.
100% win rate. Every trade was profitable.
They would close trade, yes, with zero drawdown reported by that specific system.
That's remarkable. Can you give specifics on the trades? Sure. The trade logs show the SPY puts brought in a total profit of about $64. For instance, one SPY 640 put trade returned over 21%. The TSLA trades, the straddle, generated about $59 total. The TSLA 340 call component alone returned over 19%.
So tangible profits across the board.
Definitely. And it validates the execution timing. We talked about getting profits before the SPY recovery, capturing the TSLA volatility, maintaining discipline on BTC. And importantly, the risk controls were never seriously tested or stressed.
It really does showcase how an integrated adaptive approach can work. It's not just reacting, is it? It's anticipating and having a plan B, C, and D for every scenario. Well, today we've certainly taken a deep dive into navigating a market defined by this controlled fragility. We've seen this barbell strategy in action, balancing that crucial downside protection with very targeted upside plays.
Right. And you've learned how these multiple analytical layers, CASI, DOTAs, Edge Nexus, OmniProfit, Alpha Core, they don't conflict, they actually converge to create a much richer picture.
Yeah.
And critically, how that disciplined VIX-based risk management all the way up to that ultimate kill switch is there purely to preserve capital when things get rough.
Understanding these market dynamics, it feels like it's about more than just trading. It's about appreciating how really complex systems can be managed effectively with foresight, discipline, and that adaptability.
That's a great point. And maybe a final thought for you listening. When you see how these systems identify fragility hiding beneath a calm surface and manage risk with such incredible precision, what does that suggest about the future of decision-making in other complex fields? And maybe how could we apply some of this controlled fragility thinking, looking for hidden risks when things seem fine and building both offensive and defensive strategies to manage complexity in our own lives well beyond the trading screen?
Something definitely worth thinking about. Until next time, keep digging, keep learning, and stay well informed.